The cheapest gold isn't about hype, it's about controlling premiums and fees. The cheapest way to buy gold really means minimizing the layers between spot price and what you pay. Coins often carry a 3% to 8% premium, while common bars are usually closer to 1% to 3%, so the format alone can cost you hundreds per 10,000 invested. Then the bid-ask spread, often 2% to 6%, hits you again when you sell, and liquidity can force an extra exit discount. In a gold IRA, add $175 to $600 a year, and asset-based fees rise as gold rises. Small differences in premiums and fees don't feel big until you realize they stack and repeat. Format premiums add up over time, and small buys usually cost more per ounce because the dealer's fixed costs get baked into the price. The spread hits twice, once on the way in and again on the way out. So a 4% spread is not small if you trade more than once. In an IRA, annual fees create a constant drag that compounds, which is why flat fees usually win for long-term holders. Most people overpay because they don't see the full cost structure working against them at the same time. The bid-ask spread has two sides, so the sell-back price matters as much as the buy price. Coins can cost more than bars, and some sales reps steer buyers into higher markup products that sound rare or urgent. Asset-based fees are another quiet leak because they keep growing as your account value grows, and fee layering can mean multiple annual charges. Even free promotions often get repriced elsewhere through wider spreads or higher product premiums. If your goal is cheapest exposure to gold, you want boring and efficient, not flashy. Bars usually beat coins on premium, and larger denominations tend to lower your per ounce cost because you pay fewer fabrication markups. Stick to widely recognized bullion so you don't eat a liquidity discount later when you need to sell. Always compare quotes per ounce using the same assumptions, not just the headline premium. For a gold IRA, flat fee custodians can be cheaper than percentage fees, and your storage choice should match your time horizon, not a sales pitch. The fastest way to spot cheap gold that isn't actually cheap is to control the quote and the fine print. Always ask for the delivered price because shipping and insurance can change the real cost. Check whether your payment method adds a surcharge, especially with cards, and read the return window and cancellation rules before you send funds. On buybacks, do the math as spot minus the spread. Those are not the story you're told. A collectibles pitch is a red flag for higher markups, and if it's an IRA sales flow, verify every fee and storage term in writing. A 2% to 6% spread plus a 3% to % coin premium can put you in a deep hole on day one. The smart investor matches you based on your goals and investment size, then shows the real dollar cost difference between providers and products over time. Free, takes about 3 minutes, and the link's in the description.